Welcome to today's Explainer. I am absolutely thrilled you're joining me because today, we are running the ultimate stress test. We're taking a truly fascinating green tech darling, PureCycle Technologies, and we're going to put it through the unforgiving gauntlet of history's greatest value investors. We're talking about applying the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham right alongside some strict discounted cash flow models, just to see if the massive hype actually matches the underlying math. Okay, let's dive right into this. Here is our roadmap for today. We'll kick things off with a company snapshot and then systematically run the stock through the Buffett lens, the Lynch lens, the Graham lens, and some modern DCF models before wrapping it all up with our final verdict. All right, Section 1, Company Snapshot. Let's take a look at PureCycle Technologies, ticker symbol PCT. So as of July 2026, PureCycle is sitting at about $6.17 a share, which gives them a pretty hefty market cap of roughly $1.1 billion. Now, you might be wondering, what exactly do they do to command a billion-dollar valuation? Well, they operate in the circular economy. They hold a global license for this really cool patented dissolution recycling technology that was actually developed by Procter & Gamble. Essentially, they take post-consumer plastic waste and purify it back into a virgin-like resin. I mean, it sounds like an absolute game changer for the planet, right? But let's see if it actually makes for a solid investment. Now, what's really interesting about this is the massive, almost jarring disconnect between the company's futuristic narrative and its actual financial reality. Look at the qualitative side. They've got that incredible P&G patented tech. They just scored a massive €40 million grant from the EU to build a facility in Belgium. They're targeting £1 billion of capacity by 2030. And get this, their revenue over the last 12 months grew by a staggering 590%. Sounds amazing, right? But then you look at the quantitative side, and the reality is just brutal. Over those same 12 months, net income was negative $224.8 million. They literally burned through $176 million in free cash flow, and their operating margin is a mind-boggling negative 1,563%. Ouch. Moving right along to Section 2, the Buffett lens. What exactly would Warren Buffett see if he looked at this company? To figure out what the Oracle of Omaha would think, we have to remember what he loves: a durable economic moat, consistent earnings, and manageable debt. So let's step through his checklist. First up, the economic moat. Honestly, Buffett would probably give them a yes here. They have exclusive patented tech licensed from a giant like P&G, so they definitely have a real competitive advantage in the recycled plastic space. But that's pretty much where the good news ends. Consistent earnings? Absolutely not. They are essentially pre-profit and bleeding hundreds of millions of dollars. Manageable debt? We literally have to rate this as high risk. Sure, the debt-to-equity ratio sits around 0.4, but they're carrying roughly $400 million in debt compared to just $100 million in cash. The cash burn is so bad that their auditors are actively waving red flags, citing going concern doubts regarding their cash runway. And Buffett famously relies on what he calls owner earnings to figure out a company's intrinsic value. We can approximate that here by looking at free cash flow. Right now, PureCycle's owner earnings are negative $176 million. Buffett always demands a margin of safety based on predictable, positive cash being generated for the owners. With cash flying out the door this fast, his whole intrinsic value calculation just breaks down completely. For him, the buy price, with any margin of safety today, would literally be exactly $0. All right, Section 3, the Lynch lens. Let's pivot and see what the great Peter Lynch would think. So Peter Lynch famously loved to categorize companies to really understand their story. He focused heavily on the PEG ratio, the health of the balance sheet, and institutional sentiment. He probably tossed PureCycle into the high-risk, fast-grower bucket, or maybe call it a speculative asset play. But man, look at these metrics. The PEG ratio, it is mathematically impossible to calculate right now because you simply cannot divide a negative PE by a growth rate. The balance sheet is super leveraged with that $400 million in debt. And perhaps the biggest red flag of all for a Lynch-style investor, market sentiment is heavily against them. A staggering 30% of the basic shares outstanding are currently sold short. Now, Lynch definitely loved finding hidden gems that Wall Street was ignoring, but he also stressed how absolutely crucial a strong balance sheet is just to survive the growth phase. So despite that thrilling 590% revenue growth, the crushing debt, the massive cash burn, and that intense short interest would almost certainly make this a firm avoid or even a sell in Peter Lynch's playbook. Let's keep going. Section 4, the Graham lens. What would Benjamin Graham see here? Benjamin Graham is widely known as the father of value investing. He was famous for his super strict, uncompromising defensive checklist, which was designed purely to protect investors from losing their capital. And applying it to PureCycle is, well, frankly, it's a bloodbath. Adequate size? Okay, pass. At $1.1 billion, it's big enough. Strong financial condition? Fail. The cash burn is just way too high. Earning stability? A spectacular fail, with trailing net income at negative $224.8 million. Dividend record? Fail. No dividends here. Moderate PE and price to book? Fail again. The PE is literally negative 4.9. So the crucial takeaway here is that PureCycle fails almost every single defensive test a traditional value investor relies on. But, Graham also left us his famous formula to calculate intrinsic value. It's the square root of 22.5 multiplied by earnings per share multiplied by book value per share. Let's actually plug the data from our sources into this formula and see what happens. And here is the brutal punchline. It is mathematically impossible. The consensus estimate for fiscal year 2026 earnings per share is negative 98 cents. You literally cannot take the square root of a negative number. Graham always demanded a margin of safety rooted in current tangible assets and earnings. Because the earnings are so deeply negative, Graham wouldn't touch the stock at any price above zero. Okay, Section 5, DCF and alternative models. Can forward-looking math actually justify all this hype? So all three of our historical value legends would take a hard pass on this stock today. But what if they're just being too backwards looking? Let's try some modern forward-looking valuation techniques. Since the company is currently bleeding cash, we have to make some pretty massive assumptions to even build a discounted cash flow model. Let's assume they actually pull it off. They hit their target of 1 billion pounds of capacity, and they turn free cash flow positive by 2030. Now, to reflect the massive operational and execution risks, like all those past mechanical challenges at their flagship Ironton facility, we absolutely have to assign a high discount rate, or WACC, of 12%. And for the terminal growth rate, we'll just use a standard 3% to reflect long-term economic growth. And this brilliantly illustrates the danger of buying a stock based purely on future promises. Just look at the DCF outcomes. Even if we assume flawless execution between now and 2030, heavily discounting those highly risky future cash flows back to today at a 12% WAC gives us a fair value of somewhere between just 80 cents and $2 a share. You would have to dramatically lower the risk premium to get anywhere close to today's $6 price tag. And honestly, lowering the risk premium makes 0 sense for a company that literally has going concern warnings from its own auditors. Let's check out one more alternative model really quick. Comparable company analysis. Check out these multiples. The sector average price-to-sales ratio is 1.8 times. PureCycle, they're trading at an astronomical 102.1 times sales. If we were super generous and applied that sector average of 1.8 to their projected fiscal year 2027 sales of $116.5 million, and then divided by their roughly 180 million shares outstanding, we'd get a fair value of about $1.16 per share. This tells us the current price is completely pricing in absolute flawless perfection for years to come. Finally, Section 6, Synthesis and Final Verdict. Let's bring all of this together. We've looked at the past, the present, and the projected future, and here is the ultimate summary of our stress test. Warren Buffett, $0, because he needs positive owner earnings. Peter Lynch, a firm sell or avoid, thanks to the high debt and crazy short interest. Benjamin Graham, $0 again, fails the defensive checklist and literally breaks the intrinsic value math. Even our optimistic, forward-looking DCF model suggests a highly speculative value of, at best, $2. And our comparable sales model points to just $1.16. Every single math-backed lens is screaming at us that the current $6.17 price tag is completely disconnected from financial reality. It's being driven entirely by momentum, flashy EU grant headlines, and the thematic hype around the circular economy. And man, we just cannot ignore what the broader market is saying here. There is a glaring, massive risk. Nearly 30% of the basic shares are held short. Think about that for a second. Almost a third of the market is actively betting their hard-earned money that this company is going to stumble, or perhaps that they won't be able to outrun their cash burn before they ever reach profitability. It's an enormous red flag, and it aligns perfectly with what all of our value frameworks just showed us. Which brings us to our final thought for today. Look, the underlying technology, it's undeniably brilliant. Turning waste plastic into virgin-like resin is a noble and absolutely necessary mission for our planet. But as expert investment analysts relying on strict financial frameworks, we have to separate the overarching mission from the underlying math. So I'm going to leave you with this question to ponder. PureCycle might be saving the planet, but at a valuation of 102 times sales, is it destroying your portfolio? Think about how you're valuing the big growth stories in your own portfolio. And remember, always demand a margin of safety. Thank you so much for joining me on this Explainer, and keep learning.